The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and informational purposes. Do not regard any statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. As promised, I'm going to talk a little bit about the Elliott Wave cycle for the Dow. I said I was going to get around to this, and here I am. Let's see. Which one of these I want to start with? I think I'll start with this one. Okay. All right. So what we got here is what is all this stuff at the top? Wow. I thought it only showed the tab I'm on. No, it showed everything. Okay. All right. Okay, so let me first explain a little bit about Elliott Wave theory. A very Ralph Nelson Elliott is the founder of it, and I think it's like in the early 30s. He came out with Elliott Wave theory. He named after himself, obviously, and the simple idea is he noticed through observation that there was a pattern that the way prices moved. In the same kind of way that Charles Dow with Dow theory noticed that price movement was not altogether random. Okay, and so Charles Dow of Dow theory, he came up with that observation, I think around the 1890s or something like that, back in that period. So he was observing prices, at least back in the early, let me say he was observing the prices in the 1890s. And then he came up with Dow theory, all right? And of course, named after him. So, and there's a long line of people who have been making observations in the same way that people make observations about nature and outer space and human body. We watch things over time and we start to notice patterns. And that's why on a lot of your IQ test, pattern recognition is tested, to see, because that's a mark of high intelligence. Okay. And, that's how the species evolved. We notice patterns, we record it, and we pass it down to later generations. Anyway, so Ralph Nelson is not first. Ralph Nelson Elliott is not first in the series of observers. Okay, this stuff goes back probably thousands of years. I'm thinking about, I don't recall exactly when the Japanese candlestick method was created, but it goes back. It's older than America. Okay, older than America. And the short of it is, now I'm gonna switch a little bit to a theory called that Robert Prechter of Elliott Wave International. He is the living proponent of the foremost living proponent of Ralph Nelson Elliott's work. Okay, and Robert Prechter runs an organization called Elliott Wave Theory International. Well, the basis of Elliott Wave theory thought is that prices are controlled by groupthink, basically. The intersection of sociology and economics. As people, we're pack animals. We're herders and hoarders. Okay, we hoard and we herd. That's what we do. We can't not do that. It's just what we do. And the price and the movement of the price, we create it. We're the cause agent because we assign value to things, and we change our opinion over time. Something could cost $15 today, and we'll say that's too high, and then the price will jump to $17, and then we'll be breaking down the door to try to buy it for 18 because we think, oh, it's likely to go up even more. And that's just the human nature of things. And then that kind of catches on, and it just keeps spiraling up, and prices go to ridiculous levels. Price goes to irrational levels on the way up and on the way down. Okay, and so you can see this pattern in general in price behavior. Now, even more specifically, what Ralph Nelson Elliott discovered is that prices make a pattern of going up in 5-wave cycles and then coming down in 3-wave cycles. And inside of each of these 5 cycles, each of these up moves is 5 cycles. For example, I'll just jump right here. This chart comes from Robert Prechter. He did it in 1999. He took various prices of commodities and the U.S. stock market, the U.K. stock market, gold, and different things, and he created a price chart that represents a pattern going back, before 50 AD. Okay, so whether you want to ride with it all the way here, that's a whole nother thing. But this is a working template. We're not going to go through this whole thing, but it's interesting reading if you want to freeze the screen and read these various points. But price is not random. That's the point. And I know people who come from that fundamental background and they believe the random walk idea, which is crap. Okay. Price is not random. You can't say that it is or be certain about it or speak with any degree of intelligence on it if you've never tested it. You need to come and try to learn something like Elliott Wave theory, set what you think you know, which you've never tested, which somebody just told you and it sounded logical to you. You just accepted it instead of testing it. Come learn Elliott Wave theory and you'll see that price is not random. Now, saying that it's not random does not mean that we can guess or project or calculate every top to the penny and every bottom to the penny. We can project a general area, and I've been doing that on my chart, not 100%, but with a pretty respectable degree of accuracy. Okay, and there's many others have been doing it all over YouTube. All you have to do is take your head out of the sand and see the work that's been going on in this field of technical analysis for more than 100 years. 100 years. And people are saying stuff like, you can't time the market. How do you know, of all people? Of all people, how do you know? You who know nothing about it, speak with such certainty about it. You know nothing, because the people, as Kramer said, you know nothing. They know nothing. They know nothing. Because the people who are just a little bit educated, they don't say that. They don't say that statement. They move from purely fundamental to saying, okay, I add the technicals and I practice both. I combine them. That's how you know you're talking to someone that's intelligent about these prices in the markets. That's my opinion. Remember, I'm not a financial advisor. I'm just someone on YouTube hiding behind an emoji. Okay, but it's my personal opinion. I would not use a financial advisor if they either did not know Elliott Wave theory or disrespected it, didn't think it was valid. Not Elliott Wave theory. Let me say technical analysis in general, which would include Elliott Wave theory. I'm not trying to say everything outside of Elliott Wave theory is garbage. I definitely am not saying that. But I would not use a financial advisor if they did not know Elliott Wave theory, or if they did not know technical analysis, and if they did not respect technical analysis. So it's okay if they don't know Elliott Wave theory or technical analysis, but if they at least know enough that they need to get subscribe to someone that does, or a number of people maybe that do, so they can at least be aware of what some of the dominant opinions are of people who are certified as market technicians, which I am not. So yeah, I would not. So why am I not? Why am I not a market technician? Because I'm not trying to hang my shingle out and hire my services out. That's why. Okay. But if you are a financial advisor or financial planner, becoming a certified market technician or chartered market technician, those are what those designations are called. Look it up. Google those words, chartered market technician. That would take you to a whole nother level. Because all of the people who are financial planners, I'm talking to the financial advisors out there, if you're not certified or qualified or in any level of technical analysis, many of your peers are, and they're better than you. They're better than you. All right, well, that's it. I'm gonna get off of that on that, because it just really irks me when I see people who don't know anything about technical analysis saying that, basically advocating buy and hold and not wasting time learning or trying to learn technical analysis. That's a dangerous opinion. But anyway, you got 5 waves up right here. Then you got 3 waves down. And you got 5 waves up right here. And what comes after that, at some point, 3 waves down. Okay. So we're not dealing with all of this just for expedite matters. We want to pick this up in 1784 just as a point of structure to see, right after this 3 waves down, we label the down moves A, B, C, and the ones going up 1, 2, 3, 4, 5. Okay, the ones going up are called impulse waves, and the ones ABCs are called corrective waves. Okay, so on this bigger scale, we're expecting at some point a corrective scale, ABC. All right. So this is the Great Depression decline. I'm walking you to giving you the background so that you'll understand the context for when I go to the charts of more recent times, because the more recent times fit into this structure. Okay. Right. Let's see. All right, and this another chart I'm using from someone. It's called Market Oracle. It's an article on their site, and I'm using this same chart here. I'm quoting calling out that site, just so we give attribution. But this site is also using information from Elliott Wave International, which is Robert Prechter. Okay. I'm using this for educational purposes, fair use. Okay, both the Prechter document and this, and of course, Prechter and Elliott Wave International, same person, which, and this is his company, put it that way. And so that 1790, this 1784 is the same as this. Okay. This is this person's market oracle, his labels. I'm not necessarily following these labels. But the short of it is, with Elliott Wave theory, you see 5 swings, something bad is getting ready to happen, pretty soon. But just know that we're looking on such a big scale. Soon could be, a decade at this scale that we're looking at. Okay. So we got 1, 2, 3, 4, 5 swings now. This thing is still going on. All right. So now it's going to get us to now. Let's see. This decline here, I believe this looks like the 2009 decline. So I'm about to go to my charts now, and just know that, and keep this in your mind, that we have a channel with a support line here, meaning the bottom line, where the prices bounce off the floor. Okay, have a support, and this is a general area where we'd expect to find a resistance, and the price is trading up in that area right now, which tells us also that we're kind of near the end of this trend. And not to mention the fact that I could see 5 waves in this. Okay, 1, 2, 3, 4. And whenever this wave is over, we're in since 2009, because that gets us to the now. So in Elliott Wave circles, this is what we're debating and we're wrestling with this. When does the wave structure that started in 2009, which is right here above this A, when does that end? Because when that structure is over, there'll be a correction to this cycle. So we'll get an ABC correction, more than likely going lower than 2009, more than likely. Okay. And so this area here is like 1960, and this is like 1974, and this is 2007, and this is 2009, and the off the charts up here is where we are right now. So we're going to pick up, we're going to go back and look at what I have in trading view charts, and we're going to start looking at the data from here, right here, with this Roman numeral 4, and that corresponds to basically like 1932. It's the end of the Great Depression, basically. All right. And so you had a run up from 1780, 90 or whatever here to one. You had a big correction around 18. I can't see the exact year, 1840, something like that. Almost 90 years later, somewhere near there, you had a correction. And we were about 90 years from the low here. Okay. So somewhere between 90 and 100 years, you seem to get like a correction. And like I said, we're kind of there. So, and I already said, I see this is 1, 2, 3, 4, and we got a small little move left. All right. Or do we? That's the debate. All right. Don't laugh at me, Nelson. I got this in log scale so we can see it. He knows I don't like log scale. And this is that area I said that was like 19. This is more like 60, 65 right here. And this is 74, 75. Yeah, late 74. Okay. All right. So this was the quote unquote oil crisis you might have heard people talk about, when we were lined up around the block at gas stations in around 1974. And this we were lined up here, then the correction happened. So this was around like 1973 to 72, 73, and then the price came down. Okay. Sort of like when oil hit $147 a barrel. Okay, we get stressed out. We can't handle that. And then the price goes down and it went lower. than this low here where it came up from. Okay. All right. So this was the first real major consolidation from at least here, 1942. Now y'all know we got World War II in here and all that stuff, and so you know that you can see that you don't see no big nasty drops or nothing like that because World War does not even affect price movement. Okay, it does not. Okay. So like I said, 1, 2, 3, 4. This is the 2009. I'm gonna take it off a log scale now. This is 2009. And then this starts the wave structure we're in right now. All right. Now, there's several interpretations on wave counts for this. And what I do is I argue against myself. What if I'm wrong? What's another way that this could be interpreted within the rules of Elliott Wave theory? Because, they're right. We don't know the future. We're making projections, and then we're looking at the behavior of price itself and seeing if price falls into known reliable patterns. Okay. And that 5 up and 3 down is one part. It's one of many. Okay. But that's the dominant rule of Elliott Wave theory. Okay. And of course, I'm simplifying this greatly just for purposes so you can understand this count as I go. And these horizontal lines I have on here is a Fibonacci. It's called a Fibonacci tool. And what you'll notice is, so I put the tool at the bottom of the current of where we're measuring from, which is the end of the Great Depression. Okay. And I placed it on here roughly at a level that corresponds to certain Elliott Wave prices. And so what I did, certain Elliott Wave counts, like this 2009 was a big move. So obviously that was the end of some structure, okay, some 5-way structure right here in 2007. And that had been, at that point, that was the biggest correction in this trend since the Great Depression. That was it. Since the Great Depression, this was the one. Let's see what the percentage of the decline is, or what it was. Roughly, let's just round it off and say 54%. Okay. So more than half of, everybody's like retirement account got, took a haircut. 55%, 54%, something like that. I don't think this one was that big. This was the one from January 20th. %38. Okay. Okay. So after you have the big correction, you get a whole nother 5 count. Okay. I'm not going to get into the details of this count. I'm just going to say that this big decline here is wave 4 of the structure that started in 2009. And after 4 comes 5. And at the end of 5, it's all over. All right. So what we got right here is this Fibonacci tool. And remember I said we are creatures of habits. We're pack animals. And these mathematical levels are based on, if you're an artist, you're an architect, or you draw, you probably know about the golden ratio. Well, the golden ratio also is vital in the world of price projection. Okay, in the stock market, so a lot of people trading using uh, the golden ratio and other mathematical what can I say, other numbers in that series, or uh, other price levels are price levels associated with the golden ratio. Um, for some reason, we humans in the market that trade, we respect these levels. We don't know why we do it, but for some reason we just do. So you can notice on this chart, at every one of these levels, and no, I didn't draw these on. This is a tool with these levels are pretty fixed. Now, some of them I ignore because they're like, because some are pretty minor, and I ignore it, like this one, and I just added the extra ones on here that I normally ignore, just to show the full array of um, numbers or values that are in some way related to the golden ratio. And the golden ratio is 1.618. Okay. So if the people that draw, they you can look up golden ratio and architecture, golden ratio and drawing, and it equates to beauty and balance and strength. Okay. So it 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 gets deep. Okay. It's like um it's a mathematical number or ratio that repeats itself, or that's found um a lot in nature and including our bodies. Okay. And in the art world, it has been deemed to be aesthetic. When you draw and make things at that with that proportion in mind, it's supposed to yield balance and beauty. Okay, and it's even used in music. Okay, about how long to make certain sections of a song to make it relate to this golden ratio. It gets deep, but it makes the point. Back to the point, we are pack animals, and you see what happened when we had this uh, high here in 2007. The next film, like I said, that golden ratio is 1.618. Also, 0.618 is a derivative of it. Okay. A 60, so you can round 0.618 off to 62%. So the 62% extension above the high we had in 2007, which produced this serious correction, got us to where we are. This is a 62% extension from this level, from this point. Okay. And this one here is 127. It's like a factor uh of it. It's not a whole step, but it's like a half step. It's like a factor. I'm trying not to get uh too deep in the weeds with it, but these are like more, relatively like more minor levels. Okay, but I'm just putting this tool up here to show the point, to make the point that we really are that much pack animals. And Ralph Nelson Elliott and others in technical analysis for the past 100 years, they notice that there's some type of pattern of where the market will deem that the price has risen a certain amount that is, quote, overvalued and needs to pull back. It seems like we come to an agreement, or enough of us, a critical mass of us, come to an agreement that it costs too much, and then it comes down, then it has a correction, and then we buy it again, and we start the whole process again, and then we correct again, and then we trend for another good long period, and then we correct again. But these corrections are most times mathematically spaced at a consistent amount, a consistent degree, okay? And we trend at typically about 45 degrees. You'll see most of these angles are about 45 degrees, okay? Think, okay, you gotta, think a right angle, make a L in your mind, an L. And you'll see this trend right in the middle of the L. It's something about us that we're just very mathematical, very ordered, you know. Anyway, that's the boring quasi science of it. This is a new, I'm not gonna say new field. It's still somewhat, it's phenomenal. That's why it's called Elliott Wave theory. We haven't figured all this out yet, but things happen in this with such repetition that it can't easily be discarded as just chance. And your trading bots are programmed with a lot of the findings of technical analysis, that not just Elliott Wave theory, but other forms of technical analysis too. There are people who are trading like harmonic patterns, and that's using these Fibonacci math. Okay, and Elliott Wave theory has Fibonacci math baked in it. And so it's just like a very powerful mathematical foundation to most of what's going on in these markets. That's how we're able to say we're at a key level where we can look for a correction. That's one part of it. It's not just putting up this tool. I already said to you that Elliott Wave theory counts waves. So we're counting waves and we're looking at the two. And you've also seen me in shows have oscillators up on screen. So I'm looking at that too. So when we're actually measuring it in somewhat a more objective way, and not only looking at these levels, okay? So we basically challenge the validity of these levels every time by we're mindful of them, but we'll count these waves. I'll use other oscillators, use other forms of technical analysis that don't care anything about Elliott Wave theory or Fibonacci levels, these other schools of thought, and we put them all together. And when you see all these different systems flashing sell signs around the same Fibonacci level, you go, wow. It's just mind-blowing that it's just something going on. But no matter how consistent we see price responding to these levels, we still don't just rely on this tool. Okay, but it is incredibly consistent. So now but is it perfect? Heck no. Okay, but it is too consistent to just ignore. Okay. Now, with that said, Elliott Wave theory has its 5 waves up, 3 waves down, but not all 5 wave structures are equal in size. Okay, which also speaks to why this Fibonacci approach with this Fibonacci tool is not perfect. In Elliott Wave, there's that out. That there many times it's not perfect, but it's perfect. It is perfect too many times to just totally ignore. All right. So here we are in the structure that started in 2009. And I said this is wave 4 in the structure. I think wave 1 and 2 is somewhere down here. This is 3 and 4. And then we got a 5. Now the question is 5 over? So 5 would have started in March of 2020 to where we are. And the question is wave 5 over? That's the big debate. Let me take these other values off of this tool right now because it's annoying me a bit. I don't use this one, but it is a common level. That's why it's in the tool when you get it. When you load the tool, it's already there. I just don't use that for reasons that's beyond the scope of this presentation. Because let me just say it's not in the Fibonacci sequence purely. It's a derivative of the Fibonacci sequence. It's not pure. Okay, so, but I'm not saying it's invalid, but it's not pure. I just want to keep the pure approach. Okay. So back to what if I'm wrong? What if I'm wrong? What if this move here what if this is since 2020? What if this is 1, 2, 3, 4? And what if we got one more push? It could be. Let me see. And I'm going to tell you right now as I speak, I don't know the answer to that. I don't know. Wow. He said he don't know. Right. I don't know. Okay. Sometimes we don't know. So that's where Elliott Wave theory is beautiful, because the size of the correction will give us an idea. Because if this down move is a correction of this trend here, there's a limit to how far this thing should go down. And this is about it right in this area. But if it significantly blows through that, then I know we're talking about a correction to something bigger. In which case, this would be 3, this would be 4, and this would be a completed 5, and it's on. And the big correction is on. And I think in the big correction, we'll be looking at taking out this low. This is just my opinion. That we'll be taking, and when the big correction comes, we're going to wipe out everything below after 2009 low. That's my opinion. We'll see. Again, I'm not a financial advisor. Get one. But as I argue against myself, I say there is another possible count, and that would call for the price falling down to the, let's say, to the low that we were in February of 2021, and then we just turn around and go higher and make one final push, and then I'll start the fear talk again. But I don't know. We'll see. But as I said in one of my other videos, this already gets deeper in Elliott Wave theory. Already projects to come down lower than it, quote unquote, air quotes, should, or that more than it's common. I don't want to say should. Let me say than it's common, because these prices don't go exactly to a certain area. Okay. So we'll just have to see as it goes. So now you have the context for what my last video was about for the S&P. Now you got some context for why I put up the fear porn. Because when we're talking about a correction of such a large degree, one that could take out all of this. And again, in Elliott Wave theory, we have ABC structures. And the A wave, if it's the big one, we could take all of this out from 2001 just in the A. So the ABC pattern, the A itself could just take all of this. And I don't want to be underestimating it. So I'm looking at this level, and hopefully we respect this level here, this area, from the wick of this candle here to the body. Hopefully we respect that area. It would be problematic if we didn't. I would be more concerned that it's the big one. Now, more than likely, we can do a ABC, come down here, have a weak rise that looks like a resumption of the trend up, and then die. But I don't have to know all that right now. I don't have to know all that right now. So what we do on my Patreon, we trade this stuff one swing at a time. Okay. One big 5 count at a time, one big correction at a time. And then the up move after the correction, and there are clues that the price gives once it finishes an ABC down. How do you know? Like in the ABC, you'll have like smaller ABCs as part of the bigger ABC. And how do you know the difference between when it's going up, if it's part of a bigger ABC coming down or a new trend going up? That's what we discussed. There are clues and tips about that too. And that's the inside baseball of Elliott Wave theory. And that's what we discuss during the week. And on now I moved it to Sundays, my Sunday session with the group. Okay. But that's inside baseball. So there you have it. So we don't know what this move is exactly. It could be hell or it could be a wave 4 going higher. But in the near term, it's definitely coming down. It's coming down. All right. So there you got it. Stay tuned. If you're interested in learning technical analysis, including price action theory, candlestick theory, Elliott Wave analysis, you want to learn how to apply those things to trading Forex. You want to learn how those things can help you in options trading. If you want to learn how those things can help you in trading the futures market, you want to learn how those things can help you trading the stock market, whether that's long term or short term. From meaning long term, meaning the way you would look at your retirement account when you're sitting down with your financial advisor. You can just discuss those approaches with them, what you're thinking, but you'll at least have a base of information, And if your financial advisor knows technical analysis, and Elliott Wave theory, then y'all can have a rich conversation, You'll come to the table knowledgeable, and you can put your head together with them, But I'll give you the basic tools, and you go get your financial advisor, and you make your own decisions. I'm not a signal service. I just equip you with the tools. Like I said, if you want to trade Forex, futures, options, stock charts, stocks, you want to better feel more in control of your retirement account, and even if you want to day trade, join my Patreon and get the tools. I'm out.